Welcome to a new episode at Economics Design. Today we're going to cover part 2 of Nexus Mutual. The last episode, we talked about a generalized economics of insurance. So what are the economics inefficiencies in insurance, how it's being dealt with, and what are the opportunities in there. Today we're going to dive deeper into Nexus Mutual, which is one of these insurance providers in DeFi. And we're going to cover quite a lot of different things, including the economics of the NXM token. So we're going to get started with understanding a little bit more about Nexus Mutual. For those who didn't watch the previous episode, I encourage you to go and watch it. I'll put the link up there. And if you are new to the space, then I'm going to give you a little bit more deep dive about what Nexus Mutual is, how it works, and how is the role very different in the DeFi space compared to the other different protocols out there. Then we're going to see how the protocol actually works, so how Nexus work, and then we're going to dive into the three different pillars of economics design, or the three pillars of designing token economics. So we're going to look at market design, mechanism design, and token design. Initially, I also wanted to add in some ways to improve the entire system, or how Nexus Mutual, or how the entire idea of insurance could benefit the DeFi ecosystem as a whole. But I realized that would take up like 60 slides, and I didn't want this episode to drag on for too long. So I think I'm going to have a NXM video again for the third part, so part 3, and going to dive into the improvements and how we can use insurance in a broader landscape of the DeFi protocols. So we're just going to focus on Nexus Mutual today. Let's get started with understanding what Nexus Mutual is. How does the protocol work, and how do you get involved in the protocol? There are two ways to get involved in the protocol, either directly or indirectly. If you want to participate directly, then you have to join Nexus Mutual and pay a membership fee. Now, before you start complaining about all of that, the cool thing about DeFi is that there's always two ways to enter DeFi. You either go via the regulated route, and you are completely regulated, you follow the government, you follow whatever regulations are in place, or you go to the completely unregulated way, which is how Bitcoin started. You have anonymous founders, you just have the code out there, it's all open source, and people use it. So that's one mechanism, which is the anonymous, unregulated, almost like a neo-libertarian method. Then the other way is to follow the regulated systems in place. Which one is better, which one is worse, this is not the purpose of the video, but these are two ways to get started, okay? So Bitcoin did the unregulated way, anonymous founder and all that kind of stuff. There are a lot of other DeFi protocols that followed that. Now, Nexus Mutual decided to follow the regulated way. So Nexus Mutual is an incorporated company in the UK. So you need to pay for a membership fee to enter because they have to do KYC, they have to do your AML stuff, and when you join a membership fee, you are actually a director in this Nexus Mutual company that's based in the UK. So that's pretty cool, and that's something that's quite different from the DeFi protocols out there. That being said, that's the way to participate directly. And then, once you're a member there are different ways to participate. You could be buying covers, you could be buying the tokens, you could be staking, you could be participating in governance, and all the other ways to be using and participating directly. So that's the direct way to get involved in Nexus Mutual. The indirect way is to buy this thing called a rep NXM. So NXM is the token that's used in Nexus Mutual, and you can buy it indirectly with this thing called rep NXM, WNXM. Now, this is similar. It's a similar concept of NXM. So it's when you buy one rep NXM, technically you can redeem one actual NXM out there, but it's slightly different because WNXM allows people to trade it on places like Binance, like Uniswap, whereas NXM token itself is not exactly tradable because you have to be a registered member and you have to do all your KYC to be able to own NXM. So that's the difference. It's almost like NXM is not tradable. NXM is only used within the internal ecosystem, and it's really backed by math. We're going to talk about math later behind, and to get its value. Whereas rep NXM is more subjected to speculations because you can be trading it in the secondary market. So rep NXM exists, you can go and buy it on Uniswap, on Binance, and a few other exchanges. And that's a way to participate indirectly. Now you're thinking, why are there two methods to do that? Simple. The first one is if you want to participate directly, you have to go through the whole KYC and pay for the membership fee. If you don't want, and you just want to speculate on NXM, then you do it with Rep NXM. And you don't need to be a member, you don't need to do KYC, you just purchase just like any other tokens out there. And this is a pretty good system because then all this speculation is done on the secondary market and it doesn't really directly impact the value of NXM. And the value of NXM is defined very strictly with tokens or with math. And we're going to look at that later. I'm going to look at some graphs. So these are two ways to get involved, and it's a very clear definition of the different kind of participants that will be purchasing these tokens. NXM or Nexus Mutual is all about insurance, right? It's insuring your DeFi protocols when you are purchasing these DeFi assets. And how do you get started if you want to participate directly? By buying insurance covers. You go to the platform and then you choose three things. The first one is choose the asset that you want to get insurance for. So they have a few protocols. They don't cover every protocol. They cover quite a number of protocols. So for example, I'm just using in alphabetical order, there's Aave. So Aave is a lending and borrowing protocol. And if you want to purchase Aave or you want to use the protocol, you want to use their platform, then you can buy insurance to cover just in case there is a technical bug and your losses will be covered by Nexus Mutual. So firstly, you choose the assets, then you choose how long you want to cover it for. The thing is, a lot of these trades are very short term. So you probably are borrowing and lending for maybe 10 days. So you just put 10 days in. And then you also can choose how much you want to cover for. So think of it as buying travel insurance. The assets will be which country you want to go, and then how long you're traveling for, and what kind of things you want to cover. Similarly, that's how Nexus Mutual works as well if you want to buy cover. The important thing to note is that Nexus Mutual doesn't provide the insurance itself, it provides the cover for it. What does it mean? It means that if there's any payouts required, or if something happens, or there's a bug in a technical risk in your smart contract protocol, then Nexus Mutual, the company itself doesn't pay out. It's a decentralized set of participants, of risk assessors and claim assessors to determine if you will get your returns or not, if you get your coverage or not. We're going to dive into all this participant stuff a bit later, but just know that this is slightly different from a travel insurance. If you buy a travel insurance, you are getting insurance from the company itself. With Nexus Mutual, the funds to be dispersing out in case anything happens is defined by a distributed participant. The risk assessment, so if you want to get claims, the claim assessors are also a distributed participant. And everything is just really distributed. So it's very aligned to the ethos of DeFi, or the entire ethos of crypto. So having that aside, now let's dive a little bit deeper to how Nexus Mutual work. If you want more details about the general idea of how Nexus Mutual works, how it links to DeFi and the general economics of it, just watch the previous video. The thing is, this video will be a bit long, so I don't want to have so many information in there because those are the primary, very high level things that you can find in the previous video. Today we want to go a bit deeper. So how it works. This diagram is done by Nexus Mutual, and I think it gives a very good snapshot of how the thing works. So you have three types of people in the system, or three types of participants in the system. You have a member. So these members are people who sign up for the membership and paid for the membership fee, and you can purchase the NXM token. Not wrapped NXM, but NXM token itself. So you have a member, and as a member you can buy cover. And then you have two other types of participants. The first one is a risk assessor. So a risk assessor will check the risk of something. And then the third one is a claim assessor. So the claim assessor would check the claims of something. Okay, so that's the three different types of participants, right? The member, the person who defines risk, the person who defines claims. How do they work and how is it decentralized? Okay, let's see. So we have Nexus Mutual as a platform to aggregate all these three participants together, aggregate the insurance covers, aggregate the funds available. As a member, let's say I'm a member and I go to Nexus Mutual and I go to Aave and I want to borrow something from Aave. And so I want to protect my funds that is in Aave. So I'm a member, I buy cover from Nexus Mutual. And Nexus Mutual has some funds available to be covering Aave, or like to cover my insurance cover for trading or for lending and borrowing on Aave. So I could buy a cover. Now, let's say the price is going to be 0.5 ETH, for example. It's a lot less than that, but let's just say that. So 0.5 ETH, and I want to cover, let's say, 300,000 ETH that I'm going to be borrowing and lending on Aave. So the cost, I don't know what the exact, these are just arbitrary numbers, but just imagine 300,000 that's borrowing and lending on Aave, and the cost for insurance is 0.5 ETH. And that 0.5 ETH goes into Nexus Mutual, which is, a big pot of funds. And how does these risk assessor and claim assessors work? First, we need a risk assessor. So a risk assessor will look at all the different protocols in DeFi and say that, okay, let's do a deep dive in Aave. We go and look at Aave's protocol, and then we audit the code. We look at the general information that's on the code. We look at how secure the code is. And usually these risk assessors, they're experts in their own field. So they could be smart contract coders, they could be developers, they actually know the thing. So they look at the risk and they say, okay, I think Aave's protocol is very secure, and I think this is a secure platform. I think this is a secure protocol, and I'm going to stake some tokens on the fact that I think this is secure. So let's say I'm going to stake, let's do everything in ETH, okay, because it's a lot easier first. Let's say I'm going to stake 100 ETH on this, or let's say I'm going to stake 10 ETH. 10 ETH on Aave protocol because I think it's secure. I've done the checks, I've done the audits, there's no bugs and nothing will happen in the next 30 days because the code doesn't change in the next 30 days, there's no upgrades and everything, so I think it's secure. I'm going to stake 10 ETH to validate that this protocol is secure, there is no bugs and everything. Now, because there's 10 ETH in the pool, then the member, like me, can come in to say that, oh, there's 10 ETH available, so I can purchase, I can buy the cover, and just in case anything happens, that risk assessor, that amount of money, the pool, can be used to pay out for my borrowing and lending on Aave. That's why I buy the insurance, right? Okay, so that's the general idea. And what about claim assessors? So risk assessors are like step one in the game, right? Step one to look at these protocols and say, okay, this is risky, this is not so risky, the not risky one, I'm going to put money on that. The risky one, I'm not going to put my money on there because someone's going to claim it and I'm going to lose my stake. Then step two is a member coming in and say, oh, I'm going to use the protocol and I want to get insurance for it because I'm worried. And you buy the insurance. Now step three, it's what happens when things go wrong? What happens where you actually need something went wrong? There's a bug in the code, and you need to get you need the insurance cover. That's the entire point of buying insurance, to cover your losses. And that's where the third participant comes in. They call it the claims assessor. As you can imagine, they assess the claim. So they look at the claims, what you said, and they will have a verdict. The verdict is either a yes or no. And because right now, Nexus Mutual only covers a very, very specific niche risk, which is the internal technical risk of the protocol, which means like a bug in the smart contract. So it's a technical bug, not an exploit. A technical bug is that there's something wrong with the smart contract, and as a result, you as a member or me as a member who bought the insurance has to suffer the loss. So that's what they cover. However, if the system is not a bug, it's like maybe it's a technical risk from an external system, or I don't know, one day electricity shut off and you just can't use your system, or you can't use any of the protocols, or there's a fault in the Ethereum network in general and all the entire protocols don't work, that's something they do not cover. Or if a hacker is exploiting the system through human exploit or governance exploit or whatever other exploit, but not smart contract exploit, that the insurance doesn't cover for that. So insurance is very specific, right? So that is something specific they cover. Now, we can use machines to determine that, But we can't just only rely on machines, because asking machines to verify if machines are mistaken or not, it's a bit difficult to do. So that's where humans come in, and these are claim assessors. And to be a claim assessor, you have to stake your tokens and to be a claim assessor. And then you vote, yes, this is an error and we need to pay out, like Nexus Mutual need to pay out, or no, this is not something that Nexus Mutual covers. This is like a governance exploit, so the insurance doesn't cover that, so no. So that's what they do, yes or no. So that's the general idea of how Nexus Mutual works. And if you want to go a bit deeper, when a member buys a cover, that money is just gone. You can claim the money back when there's an exploit, and then you just claim the amount of money that your insurance covers. And then 50% of it, of the cover price, goes to the staking reward for risk assessors. So what happens if nothing goes wrong? So the claim assessors are not involved. It's just the member and the risk assessor. So let's say I'm purchasing 0.5 ETH of insurance, and nothing goes wrong for the 20 days that I'm using Aave. And so the 0.5 ETH goes into the reward pool, and 50% of it, so 0.25 ETH, will be given to the risk assessors, and then it will be split by all the different risk assessors. It's not just one risk assessor, the entire thing is distribution, right? So I don't know, you have like 20, 100 risk assessors, and then all the different members that purchase the cover, like part of it goes to all the different risk assessors if nothing goes wrong. And then, the rest of the cover price goes to other places. We're going to talk about it later. And what happens when something goes wrong? So when something goes wrong, the money that the risk assessor puts, their stake, they don't get the stake back anymore. The stake will be used to be refunding the members. And the claim assessors will come in, and they will stake the NXM token, and they will vote yes or no. And depending on that, they will get returns, they will get rewards in NXM tokens, and that's the general idea. Okay, we're going to go a little bit deeper into much later on, but this gives you a better scope to start understanding how Nexus Mutual works, what are the different participants, how do we align the incentives. Because the entire thing about insurance is, how do you align the incentives between your principal and your agent? And how do you make sure that they work hand in hand so that nobody exploits the system that is a detriment to another person? So how do we align that? So that in general is how it works. And so how do you use the token? There is a token called the NXM token. How do you use the token? Where is it being used? In general, it's used in 4 systems. The first one is to buy cover. So remember, as a member, I can purchase cover of the thing that I want to get insurance for. And I can purchase it using NXM tokens. Then as a risk assessor, the guy who comes in and say that, okay, I've done the check on the smart contract, no bugs, I'm going to put my stakes on there, I'm going to put my money where my mouth is and say that there's no bugs, it's safe. You can stake with NXM tokens. And then for claim assessors as well, I come in to be a claim assessor to say that, yes, this smart contract is a bug exploit versus this smart contract is a governance exploit that we don't cover. So to be a claim assessor, I have to stake my NXM tokens as well. And lastly is governance. So if there's any governance required task, like if you want to vote on improvement proposals, then you stake your NXM token as well. Or at least that's where NXM token is used, and it can use to be voting. So these are the 4 general use cases of NXM token. Okay, so that's the general stuff. Now we're going to dive deeper into the nitty-gritty part of it, which I think is super exciting. And as always, we go back to the fundamentals. We go back to the framework that is being used to design these kind of ecosystems. We have 3 different pillars. You've got market design, mechanism design, and token design. Market design is the design of the environment, which your participants will interact with, your participants and tokens will trade with each other, will transact with each other. And we're going to look at the thickness of the market, how do we reduce congestion, how do we increase safety and ease of use for people. But in general, that's the market. We're going to design what is the environment which users or participants and the tokens will interact. Then we're going to look at mechanism design. Mechanism design is the rules of the game. So it's the opposite of game theory. Game theory is when something happens and you do a game theory analysis of the outcome and why is it at this outcome based on the different strategies and incentives and payoffs. Mechanism design is saying that this is the outcome that I want. These are the behaviors that I want to incentivize to get to this outcome. So what are the rules that I have in place so that people will behave right to get the outcome that we want? And this outcome is usually social optimizing, so everyone gets to benefit. That's the entire point. So what kind of rules can I put in place? And we're going to look at things like governance, non-financial incentives, and the different kind of structures. And lastly, we're going to look at token design. Token design is a pillar on its own because sometimes it's needed, sometimes it's not. It's needed when we're looking at using tokens as an incentive to alter the behaviors, right? In mechanism design, we say that this is an outcome that we want. These are the behaviors that we want to incentivize. How do we incentivize that? We incentivize via tokens, and that's where token design comes in. But sometimes if you're looking at some form of enterprise solution that's a very like a permissioned consortium of participants and you don't need tokens to incentivize different behaviors, then you don't have to look at token design pillar at all. But in Nexus Mutual, we're looking at a pretty decentralized ecosystem. We're looking at a lot of people coming in from different backgrounds. So we have to look at tokens as the value incurred in the entire ecosystem and how do we incentivize different participants in the ecosystem. So that's where token design is important, and we're going to talk about it in Nexus Mutual's example. And in token design, we're going to look at stuff like token policy, financial incentives, and architecture. So let's get started with market design. The thing about the entire market thickness, so market thickness is like level of adoption of the market. The thing about insurance, especially DeFi insurance, is that it's very related to the adoption of DeFi in general. So first you have adoption of crypto, and then you have adoption of DeFi, and then you have adoption of insurance in DeFi. Because insurance, it doesn't make sense to have insurance without the market itself, right? So the market is DeFi. So if we look at, this is a graph by DeFi Pulse, and in the past 90 days, 3 months, you can see a steady increase in the market adoption of DeFi. And if you look at the 1 year chart or a chart for 3 years, you can see that there's a steady increase in the market adoption of DeFi, which is a good thing. And the thing is, Nexus Mutual scales together as the entire DeFi market scales. So it's very dependent on the DeFi adoption, the DeFi market adoption. The reason why we're hearing about DeFi, or the reason why we're hearing so much about Nexus today, is that the DeFi market is maturing a little bit more every day. I mean, it's still quite immature, but it's maturing a little bit more every day. And as it continuously matures, as we have new participants coming in, as we have different types of risk-averse participants coming in, they're also demanding insurance. So it's almost like you could see that the rise of DeFi market very correlated to the rise of demand for insurance and the demand for Nexus Mutual, hence the demand for the Nexus Mutual's token. So that's in general how you get thickness of the market. It's like a chicken and egg thing, right? If you don't have the market maturity or market adoption for DeFi, then Nexus Mutual is going to be very difficult to scale Nexus Mutual, or it's very difficult to reach market thickness because it's really dependent on the market size of DeFi. And when we look at creating market thickness, how do we increase the participants or increase the network of users in the system? We look at a few ways. So the first one is a B2B market way. So B2B market is where, Nexus Mutual provides insurance, and sometimes this insurance is not enough to provide insurance just for users, but other protocols could also tap into this thing. So currently we have there are two systems that kind of like white label Nexus Mutual's insurance to be reselling it in a different way to its users or to its network. So the first one is Y-Insure. So if you heard of YFI or Yearn platform, it's a really great platform. It looks at a lot of different products and trying to allow mass adoption in a very seamless manner. So if I don't want to be actively trading, but I still want to get the different returns that is available in the market, then I can go into to the YN platform and look at the different systems in place and place my money there. So that's in general, the YN thing. And that's not enough. They also want to look at insurance because yes, I give you exposure to all these different returns in the market, very good, but I also want to protect you from the risk. So that's where YInsure comes in. What YInsure does is that it takes the insurance cover that's provided by NXM, by Nexus Mutual, and then it turns it into an NFT. They white label this insurance and then sells it in its ecosystem so that you, as a person as a user of the YN platform, I can purchase the Y insurance coverage. So, sounds confusing. The way to break it down is, you know how insurance is, in general, insurance are provided by big companies, right? So let's say I'm an insurance company and I'm going to provide travel insurance. In general, this is the travel insurance I'm going to provide. Now, what some smaller insurance companies, what they do is that they will purchase insurance, the general insurance from me, and then they will, either customize it a bit or change some aspect and then resell it to other people. That's a very specialized niche. So in general, that's kind of what it does, because the insurance that's provided by YInsure, it's only very specific coverage for the YN platform. So that's the difference. Or that's more like the similarity. So NXM is like the big boss that provides insurance, and then these other companies can purchase the insurance cover from Nexus Mutual, and then they repackage it to customize it to their platform and provide that insurance to people in their ecosystem. So that's in general how the YInsure works. Then you have a different type of insurance. It's called cover protocol. Anyway, all these things that I'm talking about, it's not insurance, it's not investment advice, and do your own research before you use them. That's all I'm going to say. So there's one called cover protocol. They are trying to do a peer-to-peer coverage market. They also white label the insurance models or the insurance cover that's provided by Nexus Mutual, and they resell it to the market. So that's the cover protocol. It used to be called Safe, and they rename it to be called Cover. And you can check them out, Google them, and you can learn a bit more about what they do. Then the other method of B2B market. So B2B market is how do you scale, right? How do you scale the users of NXM or the users of Nexus Mutual? So those are more of the white label mechanism, like B2B stuff. There's another type called shield mining, which just started. And that's why it took a little bit longer time to create this video, because I was doing a bit of research in that. What shield mining does is that other than getting NXM tokens in returns, you also get a native token from a different protocol. So if I'm covering for Lisa protocol, then, or if there's a Lisa protocol that is available, then as a risk assessor, I will stake my NXM, and if nothing happens, then I will get NXM back, and I get Lisa tokens back. And these Lisa tokens are provided by the Lisa protocol. So that's something that just started, and there's one system in place right now, or one protocol in place, and I think soon it will scale to quite big. So that's one of a B2B market thickness kind of design or mechanism. And what about B2C? So the B2C is how do you increase the different users by having them participate in the various roles. So remember, there are 4 functions of using NXM token. You have the member being to buy cover, then you can be a risk assessor, you can be a claims assessor, and you can participate in governance. So for all these different roles, you've got participants in there. That's how they participate in the roles. So the first one is the user or the member. They'll be purchasing covers. And then you have the risk assessor, you have the claims assessor, and then you have people who want to participate in all these governance votes. So these are 4 different B2C kind of participant roles. And there are ways to increase their participation. With users or members, you want them to be purchasing more insurance covers. And as DeFi continues to grow, as new people are coming into the system, that's how you have new users as well. For risk assessor, for claims assessors, as you have more protocols in place, then you have more of these risk assessors to be assessing the different smart contract risks. And then for governance as well, there's a lot of improvement proposals out there. So that's where the governance role will kick in and people be voting. It's like a time-weighted or stake-weighted vote. And that's how you increase participation from a B2C level. So a more like a peer-to-peer level. So that's for market design. It's still very general, still quite easy to understand. Now we move on to mechanism design. Remember, mechanism design is the rules of the game. So we're going to talk about governance, we're going to talk about decision making, we're going to talk about resolution, we're going to talk about non-financial incentives. Governance is really interesting. So there's two ways of decision in governance. We have decision making. Our first part of governance is decision making. And the first part to do it is through improvement proposals, so IP. And you've got your Nexus Mutual improvement proposals. So the one that just passed today or yesterday, a few hours ago, is this one suggested by Yan from Delphi Digital. And it says to pause the daily 1% MCR growth. We're going to talk about that later. But what it does is that basically anyone, because it's all peer-to-peer, right? So anyone can anyone can propose something. So the proposal is to pause the 1% MCR growth, which is something that's embedded in the system. So the proposal is to pause that. And then he wrote a proposal out, and then the proposal will go into your governance role, your governance vote. So the proposal is created by anyone, could be you and me. And then if it's approved, it goes to governance. And in governance, people will stake their tokens to see if I vote yes or no to this change, to this proposal change. And the results in the past few hours, or like 24 hours ago, is that people stake their tokens and say, yes, we want this proposal to be executed. So this is what is going to be executed right now, and to execute this improvement proposal. So that's where decision making comes in, and this is a human level decision making. Right? Humans get to vote yes or no to these changes. So this is good. The other way where decision making is made, so the improvement proposal is a more like a high level entire protocol improvement proposal. The other way to look at decision making is a more micro level, a lower level, which is where you're assessing your claims. So if there's a bug in the smart contract, if there's an error in the smart contract, then this is where the claim assessors come in. Now, there are two ways where decision making is being made. One is automated and one is not automated, which is the human aspect. The thing is, we can't fully always rely on machines because sometimes machines are wrong. But we also want to see how can we optimize the human participation by getting more information given by machines. So this is what is happening here in the claims assessors aspect. With machines, we're using oracles. So oracles to be feeding information in so that humans don't have to Google what's the information, what's the different details. All the information is provided by oracles. And then humans will be the one deciding yes or no. Remember, claim assessors, basically what they do is they stake their NXM tokens and say yes or no to should we accept this claim and return the losses. That's what claim assessors do. And this is crowdsourced by all the different participants, which are all the various claim assessors. So this is how governance decision making is made in Nexus Mutual. And what about resolution? The thing is, a lot of times we are thinking about governance as in decision making. How do we make a decision? How do we decide? How do we vote? It's all very good. At the same time, you have to remember what happens when this governance thing goes wrong. How do we resolve that? And that's why that's something that I think it's quite important a bit. Not many people are thinking so much about it. Maybe it's not the right time yet, but this is something important to consider. How do we resolve when governance goes wrong? And this is where Nexus Mutual thought about it, and they have an advisory board. So the advisory board are, not everyone gets to be part of the advisory board. These are people who are experts, who have experience, who actually understand everything that's going on. And they can do three things. The first one is to punish bad actors. So, we go back to claim assessors. Claim assessors, you've got the machine part, which is the oracles, and then you've got a human part, which is the thing that's crowdsourced. And sometimes, as much as we want to think that humans are good, sometimes some humans are not so good. They're quite bad. So this is where the advisory board comes in. And if you're a bad person by doing a bad decision, that is a fraudulent decision, that is a very negative decision that will affect everyone, then the advisory board will come in to assess if you're a bad person or not, so a bad actor or not. And if you're a bad actor, your tokens will be burnt. Simple as that. So this is how it works as well. So the advisory board has the power to punish bad actors. The second thing is they can implement emergency pauses. So, if the stock market crash, or if the DeFi market crashes, or if there's some issue that's going on that's external to the Nexus Mutual platform, and it's an emergency, something really bad happens, the advisory board can come in and implement an emergency pause. Like, we're going to pause all activities right now. We're going to see what things are doing or how things are happening. And this is important because this also works in the real world, this physical world. So in the stock market, if the prices of, if the S&P thing falls too much, then the system will pause automatically for 15 minutes for traders to, gather their thoughts again, and then the market will open again, you can start trading. So it's something similar. Instead of machines defining when to pause, the advisory board can implement the emergency pause. And lastly, they can vote on proposals if required. So, the proposal be, for example, this one that I mentioned, the daily pause of 1% MCR growth. If there isn't enough people to be voting, or if it's very technical that regular people don't really understand, or regular users, you need a bit more knowledge to be understanding if that proposal is a good or bad proposal, then, the advisory board can come in to be voting on those proposals. Now, the other part of resolution is what happens when the contracts blow up. So, as a member, you can buy these covers, and what happens when the smart contract has an error, has a bug, and I need to submit my claim I need to submit my claim to get covers for my losses. So, what happens? Firstly, me as a member, I've got cover for this Lisa protocol, and this Lisa protocol is full of bugs, and I want to get cover for it. So I go and submit my claim to the Nexus Mutual system. And this is where a claim assessor will come in, and the claim assessor will see, okay, this smart contract, I'll see, okay, and I will vote if this is a bug or if this is some other exploit. And so I'll be voting on it, and then it'll be a weighted vote. And for it to approve as this is a bug, I need to get 70% of all the different risk assessors, claim assessors together to say, yes, this is a bug, you will get your refund. And if there isn't enough claim assessors, then everyone in the membership, everyone who owns NXM token has to vote. But basically, that's the idea. So if 70% says, yes, this is a bug, you will get your coverage, then you get your coverage. If 70% says, no, this is an exploit by someone else that is like a governance exploit that has nothing got to do with the bug, then me as a member, I don't get a claim, or I don't get any coverage. And so this is where the claim assessors just do one thing, just answers one thing. Is this an exploit or is this a bug? And all they have to do is say yes or no. And then you get your coverage or you don't get your coverage. So that is the general idea of how everything works. For non-financial incentives, we're going to look at truthful voting. Voting is a very delicate subject. As you can imagine, the US elections is coming up and everyone's talking a lot about voting. Voting is a very delicate subject. But right now, it's good that we're more in a closed-loop system in Nexus Mutual, and we can look at how do we align incentives of the different agents to get the truth out through voting. And we talked about this previously in the last episode about principal-agent misalignment or incentive misalignment, and maybe in Nexus Mutual, that can be resolved with tokens. So using tokens as a way to incentivize behaviors so that we can align incentives for the principal and agent. So the principal and agent will be the risk assessors and the members who bought the covers. So how does it work? Firstly, the claim assessor has to stake some NXM tokens. Then they will behave in The behavior is to either vote yes or no for the claims. Then the advisory board will determine if the behavior of these assessors. So the assessors will determine the behavior of the smart contract, and then the advisory board will determine the behavior of these risk assessors. If they are behaving well, it's all fine and good, then they will get some tokens back as returns, as a reward for participating. But if they behave badly, then the tokens will be burned or the tokens will be locked up. So that's where the claim assessors get a share of the fee, or if you're making a good decision, then you get you get some fees, or you get some tokens, extra tokens. If you behave badly, then your tokens will be locked up for a while, so you can't use the tokens, but you still have the tokens. It's like a punishment, so to incentivize you to behave well. And if you behave fraudulently, so you are cheating, then your tokens will be burnt. And one other thing to align incentives is that there's a 12-hour cooling off period for claim assessors. So if I'm assessing the claim for Aave's protocol, then I can't assess another protocol's claim for 12 hours. And this is quite important, this is quite useful, because you don't want people to be assessing claims for a lot of different protocols at once, and then they keep saying yes to everyone, and they try to exploit the system. So there's a 12-hour cooling off period, so there's a 12-hour break between the next kind of risk or next smart contract that I can assess. So a quick snapshot that is done by Nexus Mutual, the little flow, is that first you have a claim submission, and the claim assessors will determine yes, you get a claim, or no, you don't get a claim. If majority says yes, then it is whatever the outcome is. If less than 70% comes to a common consensus, then all the members has to vote. And then whatever the outcome is, it's either yes or no. And then the use claims assessor vote, will be voted by majority. So there are two layers of voting. The first layer is, in general, these claim assessors, they will decide yes or no, 70%. If 70% says yes, then whatever the outcome is. If less than 70% agrees on anything, then all the members have to vote, and the outcome will be whatever the outcome is. Whatever the majority says is yes or no. So that's the mechanism design. And now let's look deeper into the token design. I think the token design part is really exciting. Once again, we're going to look at the token design pillar. We're going to specifically look at the token policy. So the monetary policy of the NXM token, the valuation of NXM token, and then we're also going to look at financial incentives. So the platform activities and the ROI, or returns to stake, for the NXM token. A very high-level summary of the NXM token. So the value of it is determined through a continuous token model. And as you can imagine, we're using a token bonding curve. So the cool difference, I talk a lot about token bonding curve, right? And I feel like that's the only thing I talk about, but I can talk a lot more about token bonding curve. The difference between token bonding curve, if you look behind, so the AMM token bonding curve the bonding curve that we have been talking a lot about is the AMM type, which is here. However, NXM's bonding curve is quite different, which is this one. They're almost like a mirror image of each other. And there's nothing wrong with it, because the shape of the curve is not fixed. Should it be concave upwards, concave downwards, convex upwards, convex downwards, doesn't matter. Because bonding curve is just a representation of how two variables are interacting with each other. So in general, this is the shape of the bonding curve for NXM versus AMM. And it's quite important for you to conceptualize the difference, because for AMM, it's a different kind of model. That's why the curve is like that. And NXM is a different model from AMM's. That's why the curve is like that. So it's quite different. However, the concept is the same. The concept is just a bonding curve. Okay? And how price is determined. So with AMM's, price is determined this way. With AMMs, your price of asset 1 will give you the price of asset 2. So if I'm swapping like Lisa tokens to get ETH, for example, that's where the AMM model works like that. The bonding curve for Nexus Mutual is slightly different. So we have price on one side as well. So the price is determined by this curve. And this curve, the Q here I'm talking about, is the quantity of capital. And the capital, which is the funding level of this entire system. So to make it a bit simpler, the price of NXM token, the P star you see on NXM, is related to, or it's a function, or it's subjected to the amount of capital that is being input into the system. So quite simple. As more capital is in there, as more capital is input into the NXM system, the value of token of NXM increases. So that's the general idea. We're going to go into the details later, but this is the high-level summary of how the token bonding curve, or how the bonding curve is very different for AMM versus NXM. And before I dive into NXM, I just want to have this thing quickly out of the way, the difference between NXM versus Rep NXM. As I mentioned earlier in the video, NXM is where your price is determined via the bonding curve. So there's a function of as the capital increases, then the value of your token increases, or the price of the token increases. Whereas Rep NXM is really dependent on trade. Like, it's dependent on almost like speculation, because Rep NXM technically gives you a chance to redeem one Rep NXM for one NXM by one of these NXM members. But the value, like the real Rep NXM value, is still quite subjected to speculation and trading, which is completely fine. So what I'm trying to say is that the way to get the value of NXM is fixed with math. The way to get the value of Rep NXM is not fixed. It's quite dependent on speculation and trade. So let's get that out of the way. And everything else for the rest of this video is talking about NXM itself. Rep NXM is determined by a lot of other secondary market and trading, and let's not talk about it. Let's focus on NXM. So we get started with the monetary policy. With NXM, there are two functions in the math that we want to talk about. And as you can see, this formula over here. Now, that is the formula for determining the price of NXM token. And there are two variables in there. So there are two variables that's fixed and two variables that's flexible. And I'm going to circle the fixed one out, and I'm going to underline the variables out. So you could see that A and C are fixed variables, and we're going to dive into that a bit deeper anyway. And then the thing that changes is the MCR, and this other thing called the total capital, or capital pool. These two variables are important because what do they signify? If we look at MCR, MCR is kind of like the reserve in a bank. Have you heard of fractional reserve? So if I put $100 in my bank, the bank will, by some laws of the government, it's changing a bit in 2020, but let's just say that the government says that you have to take 20% of your deposit, the bank has to take 20% of deposits and put it in the bank as a reserve. So if I put $100 in the bank, $20 will be in the reserve that the bank cannot touch, and the rest of the $80 can be used to be lent out to other people. So that's fractional banking, that's fractional reserve. NXM does something similar. So if I put $100 ETH as capital into the NXM pool, part of it has to go to reserve and the other part is available. So that's the general idea. And that's what MCR is. MCR is the minimum capital requirement. It's kind of like the reserve in the bank. The second part is the total capital or the capital pool. And if you want, just now we talk about market design and how NXM is quite related to the DeFi market growth or the DeFi growth. So the total capital increase, you can think about it as the increase in DeFi adoption or DeFi market adoption, DeFi protocol adoption. So as more DeFi protocols are being adopted, you can argue that there's a correlation to an increase in the total capital. So these are two variables that is included or that is involved in this model. And this is very important. Why? Because MCR, so the reserve in the bank, is like a short-term forecast or short-term variable to understanding the growth of Nexus Mutual's protocol. Whereas the total capital, this variable, is a way to look at the long-term growth of Nexus Mutual. Really cool, right? Because we're looking at this formula where it involves both short-term variable and long-term variable. Again, short-term variable because these are amount of money or reserve that you could use to do your insurance cover. Whereas the long-term growth is the total capital, which is linked to DeFi adoption. How cool is that? And because of that, we're going to look at three elements in the bonding curve. The first one, as you can imagine, is the total capital. The second is the MCR, so the capital requirement. And this capital requirement is important. So in case anything happens, this insurance cover, this minimum capital can be used to cover the insurance. And lastly, it's the MCR ratio. So the ratio, because we only have two variables, right? The MCR and the total capital. So the MCR ratio is it's the total capital divided by MCR. So the linking between these two variables. So MCR is the short-term growth, total capital is the long-term growth, and then we're going to look at the interrelation with them. And then we have these three different variables added into the model so that the model can give us a more robust understanding of the entire ecosystem through the price of NXM token. Make sense? The price of NXM token is very cool because it's not only just giving you the value of what NXM, the system does, but it also takes in the short-term growth, the long-term growth, and the relationship between the short-term and long-term growth. And that's why NXM is very interesting. Let's look a little bit deeper at the bonding curve. As I mentioned, this is the formula. So the price everything is based in Ether. So the price of the NXM token is A, which is A and C are two fixed amount. And then the MCR also priced in ETH. It's the minimum amount of capital required to cover the existing covers. And this is, so they of course we're looking at, the minimum capital requirement, you could use 100% of the capital that is added into the system to be used as the minimum capital requirement so that people can be always covered, right? You're always assured. But at the same time, if you think about it, that's quite inefficient use of capital, because this capital is, I know it's insurance, right? And the thing about insurance is that everything you insure, it doesn't always happen. Like the bad things don't always happen. So you just buy insurance as a hedge. And if these things don't happen, but you still have your capital sitting there, just preparing in case these bad things happen so that the insurance, the capital could cover it, then it's a very inefficient use of capital. So they've done some calculations to see what's the probability of bad things happening. So what's the minimum capital required to cover these bad things? Like this minimum level of bad things. So we call them the minimum capital requirement, MCR. And then you have your MCR percentage ratio. So that is the capital pool divided by the MCR So capital pool is the total amount of collaterals in the pool. If you think about it, if you are very comfortable with AMMs and decentralized exchange, capital pool is kind of like a liquidity provider. You have this big pool, and then you just provide your capital inside. And in AMMs, that's where people can be swapping and trading and doing your exchange. Similar concept where you have a big pool, and then you put ETH in there to get your NXM token out. So it's a similar concept. So that's what total capital is. Total capital is something like a liquidity provider or liquidity pool. Then the capital requirement is the minimum amount of money required to pay the claims. Let's say 1% of all the claims are defaulted, and you have to pay out, and that is what the minimum capital requirement is. That's how you get it. And the ratio is capital efficiency. It shows capital efficiency. So you have the capital divided by the total capital divided by the requirement. So it's how efficient your capital is being used. Remember, if I take 100% of the capital or the total capital, and I put it store in my safe, so just in case any bad thing happens, then we are always assured that there is enough money to repay. That's good, right? But if nothing happens, and you know that you're 99% sure that out of this 100 ETH that's in the pool, 0.001% is going to be pretty safe. Or it's going to be really safe. And so we want to take this 0.001 ETH out and use it somewhere else. So maybe you can use it in other kind of system to be getting returns. And that is efficiently employing capital. We talked about this in one of the first few slides in the previous video of how insurance is such a big market. Because they aggregate risk from everyone. But the thing is, not everything will happen, not all the bad things that they cover in insurance will happen. So then they have this pool of capital available because people are buying risk, right? And some people are super risk averse. So people will be paying more. And because of that, insurance companies can use this capital available, and reinvest it somewhere else so that they can be earning more money. And this is why the MCR ratio is quite important, because it talks about capital efficiency. How efficiently is capital being used and deployed in the system? And now I want to dive a little bit deeper into understanding the changes in monetary policy. There's 7 questions that we want to answer. The first one is, how does the graph move? How do we change the shape of the graph? What happens when the capital pool increases? What happens when more cover is being purchased? What is a dynamic capital floor, which is something that they have created? Why do we want to increase the MCR ratio? So as Nexus started, they increased the MCR by 1% every single day. And why is that done? And also, why is the improvement proposal that was just approved about 24 hours ago, why did they want to stop this 1% MCR growth? So all these questions are related to the monetary policy or the token policy of NXM. And I want to answer them. So let's start with the graph part, okay? Two things. How does the graph move, and how do you change the shape of the graph? So I've done a little graphing out here, and this is your model. I didn't name them properly, so sorry about that. Basically, the C is correct. The B actually represents A in the model, and A represents the MCR. So what I'm graphing over here, technically the entire model of Nexus Mutual is a 3D graph, because we have 3 variables. The first variable is your token price, the second variable is the MCR, and the third variable is total capital pool. Now I'm just going to assume that the MCR is fixed. So we're going to take a snapshot in time right now. Things are fixed. And what happens when the capital pool increases? Because the capital pool is a lot easier to understand, because as a user, to increase the capital pool, I basically put more money into the system. Put more ETH into the system, and then it changes it changes. So I just want to show you a very quick understanding of how it works. How does a change in the capital pool affect the change in prices? So the first question that we want to answer is, how does the graph move? So how do you move along the graph? Let's take a snapshot of the system right now. And now nothing changes, everything is on pause. What can we understand from the graph? So if there is X amount of capital, like the graph line shows that at X amount of capital, what would the token price be? So if the capital increases, then you just find go along the graph line, and you realize that the price of the token, of NXM token, also increases. That's the idea. So that's how the graph moves. So the way to move the graph is to add more capital in there and increase the token price. Or if you remove capital in there, then you reduce your token price. So how do we do that? You can add more capital, so add more ETH to exchange NXM. So you're paying ETH to buy NXM. And each NXM you purchase is different price. The price is determined by the bonding curve. And basically determine how much it is to buy like 100 NXM token. You basically use the graph and then figure out the area under the curve to determine the price. That's how you get it. And if you want to reduce or go down along the line along the graph, then I will sell my NXM token and I can redeem it for the capital that is the area under the graph as well. So that's how it works. That's how things can move along the line of the graph. The second thing is, how do we change the shape of the graph? So because this is really mapped to the price of token versus capital, and you can see that as I increase my capital, as I increase the capital being put in, then the shape of the graph changes. So as more and more capital is added into the system, then the curve is a lot more gentle, which means the increase in one token being purchased, or the token price of token 1 versus token X plus token X plus and token X plus 1, the change in value is a bit less. So it's a bit more efficient. But if I have very little capital, then the graph is very steep. That means the price difference between token X and token X plus 1 has a more significant difference, so a greater marginal difference. So long story short, more capital, more gentle the curve, which is better for trade or better for pricing, because the price of the next token is not that much different than the price of the previous token. So in general, that's how the shape of the graph changes. Now, let's look at what happens when the capital pool increases. And let's go to the whiteboard. And I'm just going to be writing it out, and I'm going to be talking about it later. So what happens when capital pool increases? So when capital pool increases, the X increases. As we can see that the X increases, the line becomes more gentle, right? And if all things stay the same, this is what it is. So if capital pool increases, then the entire thing of capital pool divided by MCR percentage times the power of 4 increases, and then the entire thing variable increases, the multiplication variable increases, and so the price of token increases. That's the general concept what happens when the capital pool increases. Now, what happens when more cover is purchased? So firstly, when more cover is being purchased, your MCR increases, right? Because as more cover is being purchased, the minimum amount of money you need increases. So because that's the minimum capital required to cover this cover being bought. At the same time, something else increases. When I'm adding money to buy cover, I'm also adding money into the capital, right? The total capital pool also increases. And so now we have two variables. We have MCR increasing, and then we have the total capital pool increasing. And this is important to note, because this part, the ratio of both of them, it's quite important in determining the price of the token. So now we have to see which one increases more. And in general, the total capital pool actually increases more than the minimum capital requirement. And if you just think about it intuitively, the MCR is called the minimum capital requirement. And in general, the minimum capital requirement is much lower than the total capital pool. So that helps you to conceptualize why total capital pool is more than the minimum capital requirement. So similarly, when the cap pool increases by 2 arrows and MCR just increased by 1 arrow, in general the entire variable increases, and so P, the price of token, increases. So what does it mean? It means that as more people purchase insurance, the price of NXM increases. And also, going back to the previous one as well, what happens when capital pool increases? As more people add money to the capital pool of Nexus Mutual, the price of NXM token increases. What is a dynamic capital flow? So I added a dot on the graph and a much lower end, and it's called the dynamic capital flow. As you can imagine, what a capital flow is that it's the minimum amount that is needed. There are two types of minimum amount. One is the MCR, which is the minimum capital required, and the other one is this capital flow, which is the least amount of capital needed in the system. And it's dynamic because it changes based on the different variables that's in there. And this is important because the dynamic capital flow it's lower than the minimum capital requirement. So just in case if things go bad or things go wrong, you have this variable there to allow the advisory board or allow people in the Nexus Mutual ecosystem to understand that, we are reaching very critically low volume. And that could be one of the reasons to create the emergency pause in the system. The next one is, why do we want to increase the MCR ratio? So what is the MCR ratio, and why does it need to increase? So currently, the MCR ratio is more than 130%. And this is important because your total capital, so the MCR is the minimum capital required. And so the ratio shows the total capital divided by the MCR. So it's a lot more than the MCR, so that if MCR is where the minimum capital needed to cover these insurance covers. And you want your capital to be above that, so just in case a lot of other bad things go wrong, then you have enough capital to be covering that. So it's 130%. And so previously they were always increasing the MCR ratio, so that by increasing the ratio, it means that you have more capital available to be covering the MCR. And this is in general a good thing if you think about it, because remember, we talked about this ratio being the capital efficiency, right? So the MCR ratio shows how efficiently the capital is being used and being deployed. And if the ratio is very high, it means that there's a lot of capital available that is not being used as the reserve. So that means we have a lot of capital available to be used for other things, like other kind of investment, other kind of funding, other ways to get returns on your capital. If the capital is very low, it means that a lot of these capital are being used for your minimum capital requirement, which means being used, they're like stagnant, it's a reserve just in case anything happens to be used to return to the system. And this is good because if the MCR ratio is higher, that means capital can be employed more efficiently and more robustly. Now, let's move on to the last question. Why does the improvement proposal want to stop the 1% MCR growth? So, I didn't talk about it just now, but one of the things that is embedded into the system is that for every 24 hours, the MCR will grow by 1%. So in general, anyway, the MCR will keep growing by 1% every 24 hours. That's the system that they created for Nexus Mutual. And that's good because the MCR is the minimum capital required, and as more covers are being created, then you need to grow your MCR, right? That's good. So every 24 hours, it will grow by 1%. So any capital that's being put in or any capital that's out there, they will keep siphoning out part of it to go into the reserve, just in case there are covers needed. And that's where the capital will come from. And then there's this entire DeFi boom. So in this entire DeFi boom, a lot of people are buying covers. And so what Nexus did was that, okay, so many people are buying covers, we need to increase our MCR so that if anything happens, then there is enough capital to be deployed and returned to be covering the losses of these insurance covers, right? Okay, so what they did instead of every 24 hours they increase by 1%, is that every 4 hours they will increase by 1%. So what does it mean? If we look at the capital efficiency again, we are increasing MCR by 1%, right? It means that our MCR ratio will drop. So previously, I think at one time this MCR ratio was 143%, which is good efficient use of capital, right? There's a lot more capital than the minimum capital requirement to cover the losses. So then you can use this capital efficiently. And what they've done now is to grow the MCR a lot quicker, which means it will reach back to the 130%. So to drop that MCR ratio. And because there's more demand in the DeFi ecosystem, which is good. But this improvement proposal says that we should stop the MCR growth. And the answer is quite simple, because if we keep going back down to, the MCR ratio is lower and lower, it means that we're using capital inefficiently. Because a lot of these capital can be used to do other things, as I mentioned, to be funding, to look at different kind of returns in different kind of protocols. But we are just keeping all of them in the reserve instead, just in case something happens. So that's what they want to do. And that's why they want to stop the 1% insane growth for a while, because there's more than enough to cover the existing insurance covers for now. These are various examples of how monetary policy can be changed for the Nexus Mutual token. And it's super exciting and fun, because if you think about it, number one, the policy itself, the monetary policy, the math, includes a lot of different long-term, short-term variables, the capital efficiency or capital allocation efficiency in the system. And it has all these variables into the math. And then at the end of all these different variables, it comes out a price, which is the Nexus Mutual price, to tell you the risk or the value of the system. Good stuff. Then the other thing is that people can just propose changes and other people will vote on it. So this is really what the entire DeFi space is looking to do. It's decentralized, anyone can participate, anyone can vote, and the prices of tokens are not because of speculation outside, but because the market or the ecosystem or this platform is robust, and it creates a lot of value. It aggregates future value and short-term value into it to give out prices. And from there, as a regular user, you don't know how to analyze all these different pricing of different protocols. So you see this token price as a way to understand the long-term potential of these protocols. And that's why I think it's super fascinating. And Nexus Mutual is doing it pretty well. So that's all for the monetary policy part. Let's look at the token supply. So with the bonding curve, this is called a dynamic token supply because the supply of the token changes based on the capital required, right? The capital inside. And then the price is determined via math. We can increase the price through performing risk assessment, performing claim assessment, participating in governance. We can not increase the price, increase the supply of tokens by doing these things, because if you are part of risk assessment, part of claim assessment, if you participate in governance, you get additional NXM tokens. So you stake your NXM tokens, and then you can get additional NXM tokens. To decrease the supply, and decreasing the supply means to decrease the supply, then the advisory board will burn fraudulent claims. So for a claim assessor, when they stake their NXM token and people found out that they're bad actors, they're fraudulent actors, then their tokens will be burnt. And when you burn your tokens, then the overall value of tokens actually increase. The other way is also when you're purchasing cover, you can purchase covers in two ways. You can purchase in ETH, or you can purchase using NXM tokens. Right now, they're only using these two tokens, currencies, to be purchasing covers. And when you use NXM tokens to purchase covers, 90% of that will be burnt. Why? Because when you burn these tokens, then the remaining value of the tokens actually increase, which is quite cool. And so that's how the token supply changes. And what about valuation? Again, the valuation is done via the bonding curve, and it's priced in ETH. And right now, the math is whatever that we saw on the whiteboard. In the future, they're going to look at FX exposure. So in the future, you could look at, other than ETH and NXM, then you have other currencies available to be purchasing. And as the currency increases or decreases, then you have different variables that will be affecting the price of NXM token. Because NXM token is really an aggregator of everything that's happening in the ecosystem, on the Nexus Mutual ecosystem, and giving you a price and value to show you what the risk or potential is. Then another thing that they're looking at in the near future is this thing called a gearing factor, which will change a little bit of the math, but gearing factor is really how diversified their insurance cover is. So for example, if they're only going to cover like lending protocols, and 90% of all the insurance cover is only just to cover Aave, then it's quite volatile, because if Aave has a bug, and if 90% of the insurance covers is only on Aave, then there's a lot to pay out, and this would definitely destabilize the Nexus Mutual ecosystem. So this gearing factor that they talk about is a way to increase diversity or diversification of the Nexus Mutual platform. Okay, what about the financial incentives? So financial incentives, we're going to look at platform activities. As I mentioned, there are 4 platform activities. You can buy cover, you can assess risk, you can assess claim, and you can vote in governance. So if you buy the cover, then 90% of the NXM used to buy the cover will be burnt. And when you burn the NXM, then the value of the remaining NXM increases. And then 10% of the NXM will be retained by the member and goes to the collateral pool. And this is when there's money to be, like there's rewards to be given out, then that's where it comes from the collateral pool. The other one is to claim assessment. So you stake your Nexus Mutual to be voting on claims. And if you vote with consensus, so if you vote alongside with 70% of the people, and they all say yes, and you vote yes, and that's 70% of the majority, then you get more NXM tokens. If you vote against, so if 70% say yes, and you're the few that says no, you still keep your NXM tokens, just that it'll be locked up for a while. So you can't use it for a while. There's like punishments for saying the wrong stuff. But you still own your NXM tokens, However, if you vote fraudulently, so if you vote badly, if you're a bad actor, no, it's not that you're lying or anything, you're a bad actor, then your tokens will be burnt. And when your tokens will be burnt, then the overall value of the NXM token increases. For risk assessors, you stake against a smart contract, so that's where you put your NXM token there to stake. You can also use ETH. And then when a cover is being purchased and nothing goes wrong, then you can get some of the NXM tokens, or you can get some amount of money that's given by this cover, these people who purchase the cover. And then if there is a claim, then some of the stakes will be burnt. So the NXM that you staked, some of them will be burnt. You will still keep some of them, but some of them will be burnt. It's almost like punishment for not auditing the smart contract well enough to realize that there is a bug. Something like that, something along the lines. So that's how you use tokens to align incentives. And lastly, you've got governance, and you can stake your NXM token to be voting on that, and it be a weighted vote. So the other platform activity is that, going back to the bonding curve, we are exchanging NXM for ETH. So if we look at the curve, there are two variables, right? Because bonding curve is all about interlinking two variables, and the two variables that we're interlinking is NXM and ETH. So in the curve, we're linking two variables, which is the native token NXM and the capital pool, which is defined in ETH. And then that's the two variables we want. Then the relationship is the math, and that math is getting in the variables on long-term and short-term potential of Nexus Mutual. And then you link these two variables together, which is really cool. And you could change it very easily by having changing the capital or changing the MCR, and you could change. Yeah, so you could change the shape of the curve, as we mentioned, by having more capital, or by having the capital floor that we talk about, the dynamic capital floor, or having the MCR, which is the minimum capital requirement, and you could change the shape of the curve. You can change how much NXM you can exchange for ETH, or how much ETH you can exchange for NXM. Then we're going to look at ROI risks. So in financial incentives, we also look at ROI, like returns to investment or returns to stake, and the risks involved. So one of the risks, as I mentioned, was if in Nexus Mutual, 90% of the insurance cover is used to cover Aave, just one of these protocols, or like the Lisa protocol. So if 90% of it is to cover the Lisa protocol, and if the Lisa protocol is like super buggy and completely gone to like super shitty, then the Nexus Mutual will be very badly affected, because a lot of them will be paying out to these Lisa protocol. So one thing to think about, or one thing for them to realize, is that you need to diversify your risk. Diversifying your risk as in giving insurance covers to a lot of different protocols, different protocols, different segments of protocols, different DeFi categories, DeFi industries. Really want to diversify your risk. And one way to do that is having like a hard limit, saying that, in 100% of the funds available, then I only want to do like 10% maximum of this 100% available to be covering each protocol, or to be covering a segment in protocol. So like AMMs, or like decentralized exchanges. Only 10% of the total capital that we have can be used to be covering these insurance for this particular segment or this particular protocol. So then it forces people to diversify. So you can increase your funds by putting more capital in, and then you can increase the exposure. It's still hard limit of 10%, but you can increase the amount of capital that is directed to covering DEXs. And so that's one way, hard limit. The other way is to have a variable. Right now they're calling it a gearing factor, to diversify the risk, to understand what is the diversification level of the insurance covers. So the higher the diversification risk, the better, because as we diversify more, then we're less impacted when one of them goes south. So that's one way to deal with the risk. And the other way to look at ROI is shield mining that I talked about just now. So shield mining is when a protocol also comes in with Nexus Mutual. So let's go back to Lisa protocol. And if I'm partnering, or like if Lisa is partnering with Nexus Mutual, then for claim assessors, when they stake on the Lisa protocol, they will get NXM as returns. And not only that, they can also get the Lisa token as returns. So this is another incentive because we want to incentivize people to stake more, and this can help with mass adoption. Not just mass adoption for Nexus Mutual, but mass adoption for Lisa protocol, because number one, more people get access to Lisa protocol because I get claims in the Lisa tokens. Secondly, it's also another way to signal that these claim assessors are confident in the Lisa protocol's future, because not only do they get NXM in return, they also get the Lisa token as return. And for me to want to demand Lisa token in return, I am basically signaling to everyone that I think there's a long-term future of the Lisa protocol, and that's why I'm willing to accept Lisa token as a different incentive. That's a lot to wrap around. So in general, number one, other than the NXM token that I receive, I can also receive the Lisa token. Number two, the claim assessor receiving Lisa token is a signal. So we talked about signal in the previous video. It's a signal to tell everyone else that I've got faith in this protocol. Not just because I'm staking on it, I'm staking my NXM on it, but I'm also willing to receive Lisa tokens as returns because I believe that there's a future value to that, and that's why I'm willing to receive it right now. So that's the economics of shield mining, which is a very interesting way to align incentives between the agent and principal, which is the NXM, the yield, the protocol itself, the Lisa protocol, and the risk assessors. So that's a really cool way to realize the economics of shield mining. That's all for today. There's a lot to cover. There's a lot I chat about. And in the next video, I want to talk about what are the improvements that can be done. So how else can we use insurance to increase adoption for DeFi, to increase protection for people, and how else can we use the economics of signaling and aligning incentives between principal and agent together to increase security and safety for people to come into the DeFi space? And how else can we define the ROI for users to come into the space with Nexus Mutual? So that's another big topic on its own. I've been wrapping my head a lot around it, and I wanted to include it in this video. But this video is already quite long, so if I include that will be even longer. So anyway, I really hope you enjoyed this. I hope the deep dive was good enough. And there are a lot more places that we can deep dive if you want. One is looking at the capital model, and one is looking at the MCR model. The capital model and MCR model is not just random numbers they plucked out of the air, because the people who created Nexus Mutual, the team, they have really good experience. They used to be doing all these. Remember I told you that insurance is basically pricing risk? So there is a specific kind of job scope to be pricing that. They are called actuarial scientists. And their entire life, it's pretty cool. They take data, they find out how to price risk. So the team has a lot of experience in that. And that's why there's a lot of math and considerations behind how the capital model is done, how the MCR model is done. And that's a lot of math. So if you want to do that, let me know if you're interested in that, and I can go deep dive into it. Otherwise, the next video will be very much focused on the improvements and how other protocols can partner with Nexus Mutual to increase adoption for DeFi. At the same time, Nexus can be allocating its capital a lot more efficiently. So I'll see you in the next video, and if you have any comments and questions, just drop them in the comments below, and I'll speak to you in the next episode. Bye!